This is not going to last forever. All good things, unfortunately, come to an end. Just ask this guy, a USC football fan. Remember those mid 2000 Pete Carroll run football teams? They just look so good. 34-game win streak. And then we lose to Texas in that terrible, terrible Rose Bowl that I still honestly have not watched highlights from because it's just too traumatizing. Another thing that had to come to an end, Blockbuster Video. Remember those Friday nights? We'd get the family together and you'd go pick out a movie and it'd probably take like 30, 45 minutes just to pick out one movie. But man, you'd come back, you'd get some pizza, watch a nice VHS, good times. Or who can forget the iPod? You go out for a run and you just have music. You don't have that stupid phone, stupid mobile phone with the computer in there to distract you. You just get to listen to music and go for a nice run. But no, that is not what this video is about. Let me tell you what it's about. It's about the last 15 incredible, and I mean incredible years of the stock market that we have had really since the Great Recession ended in 2009, 2010, whichever date that you want to pick. I'm going to put up on screen right now the performance of different asset classes, large size, medium size, and small size companies over the last 10 years. And I just said 15 years, but this data is just 10 years. But believe me, going back to 2010, man, incredible returns. So let's look at US mid cap. Over the last 10 years, we've got a 9.91% rate of return. That is absolutely incredible. Small cap trailing the other two at 8.67%, but that is still a fantastic return. And then large cap, as we all know, has been the best performing asset class over the last 15 years, and the 10-year return is around 13.51%. And all of this is data ending through July 2025. So it doesn't include August, and I'm recording this on August 26th. So it's a little off, but you get the point. My point here is that these returns are not going to last forever. These returns are far above the historical average, with large cap leading things by a significant margin. And 2025 so far has been pretty good, and we'll just pull that back up. So year to date, small cap, pretty dismal, 1.14%, mid cap, 9%, large cap, 8.49%. But what I want to tell you about today is that this is not going to last forever. You cannot fall into the dangerous belief that these exceptional returns that we have had over the last 15 years are the new normal. They're not. We are going to have something called a reversion to the mean. We are going to get back lower to the historical returns of the stock market. And why is this going to end? I don't know. I really don't know. It could be slowing economic growth. It could be some kind of geopolitical event. It could be inflation rearing its head again. It could be interest rate changes, which we pretty much hear in the news every single day with Powell and Trump. Or it could be something completely unexpected. Market cycles always end, but it's rarely for the reasons that experts predict. So the catalyst to me does not matter so much as the fact that we know it will end at some point. And so smart investors, which is you if you're watching this show, listening to this show, they need to take steps to prepare for those lower rates of return coming in the future, because we know we can't predict when the future is going to happen, but we know that all market cycles eventually turn. And so I've got 5 ways for you at home to prepare for what's coming next. The first one, and I've said this before, so it's just going to be really quick, is rebalance your portfolio. If you said, I want 80% in stocks and 20% in bonds, and you haven't looked at it in a while, there might be a chance that those 80% in stocks might be in 90% stocks because the value's gone up so much, whereas the bond portfolio hasn't done so great, and so that might be down a little bit. So if you started at 80-20 and you're at 90-10 now, let's sell a little bit, as long as you know what you're doing, and make sure it's not a taxable account because that's long-term or short-term capital gains. Sell a little bit, so you get that 90% back down to 80%, get the bonds from 10% back up to 20%. So that's rebalancing, just really quick, because we've talked about that so much on this channel. Second thing that you need to do to prepare is you need to start de-risking 5 to 7 years before retirement. Now, the traditional advice, and this is a little hard because there's a lot of diversity of thought in the financial planning profession, which is fantastic, and a lot of advice tends to say you need to start de-risking 10 to 15 years before retirement. I have to say, and I'm a bullish stock person, I just think that's a little overly conservative. There is a big risk called sequence of return risk, and I'm going to make sure it's one of the videos that pops up at the end of this video because I've talked about this. But sequence of returns risk basically says if you start off your retirement and you get some bad returns, it could damage your long-term health of your portfolio. Whereas if you get good returns in the early years, that could be really great news for the longevity of your portfolio. And so we definitely want to avoid that as much as we can. We can't control outside events. If you retire in January 1 of 2008, like that's just really terrible luck, and you can weather the storm. And if you would have held on and done some things, I think you would have been okay, but that's just terrible luck. So we want to mitigate those risks as much as possible. And one way we can do that is by de-risking 5 to 7 years before retirement. I think 10 or 15 years before retirement, it's a little too conservative to me, but I do work with a lot of pre-retirees and they're pretty aggressive. They're in 100% stocks. So if you're within that 5-year time frame, I can't make any recommendations, but I would look at it and just ask yourself, ask your spouse, and then talk to a qualified financial advisor and say, is this really appropriate for us right now to be 100% in stocks, or should we take some money off the table and get to a 80-20 or 70-30 stock to bond portfolio? The second thing that you need to do to prepare for the end of this amazing US run that we've had is diversify globally. I have also met with a number of clients, I might even say the majority, where they really only have US assets. And over the last 15 years, that has made the most sense. The US has absolutely demolished international over those 15-year periods. But the global market cap right now is around 62% US and around 38% international, roughly. And so if you're 100% in stocks, you're missing a big part of the global economy. And then my second point on this is that international, at least right now, offers better valuations. It can offer higher dividend yields. And at different times in market cycles, it's outperformed US stocks. And so I think that will turn at some point. I just don't know when. But when that does occur, I want you to be ready with international stocks as well. Quick little point before we go on to the next one. So far this year, as when I calculated this, international stocks were up around 21.7% year to date, while the overall US is up around 9.4%. That was like 7 to 10 days ago. So it's changed. My point is, this is the first year that we've had international really outperforming the US, and that might be the start of a new cycle where international outperforms the US. My fourth point that I have for us is don't abandon your emergency fund. When you see these, 7 to 8 to 9 to 10% returns in the stock market over the last 10 years, it's really easy to say, hey, let's just put it all in the stock market and don't really worry about an emergency fund. I think that's a little short-sighted because we will have economic uncertainty at some point. We will have a reversal to the mean in terms of the rates of return. And man, these interest rates that you can get in a high yield savings account and some kind of money market account, it's 3.5 to 4%. It's pretty darn good, especially when you compare to the less than 1% that we were getting just 5 years ago. So I would not abandon your emergency fund. And as a retiree or soon to be a retiree, my recommendation is get close to that 12 to 24 months of living expenses as your kind of buffer zone when you get into retirement. So more than 3 to 6, which is what I tell people working, 12 to 24 months is my recommendation for emergency funds in retirement. And then my last point, which kind of goes into this, the last point that I just made, which is you got to resist recency bias. And so one recency bias that people have is, like I just said, let's forget cash. Let's forget my emergency fund. Let's put it all in the stock market because we're going to get a higher return. And, historically, that's going to be accurate. But we just don't know with those short time frames, like 3 to 5 to 7 years, cash actually might outperform the stock market if we have a really bad market cycle. And so my second point in terms of the recency bias is we've got to remember that U.S. large cap stocks have done extraordinarily well in the last 15 years, and they've outperformed all other asset classes those 15 years. That will not continue forever. At some point, international or U.S. small cap or U.S. mid cap is going to outperform large cap, and they'll do it over a multi-year period. So this tech infusion, these tech companies with amazing returns, they are doing great. But it's not going to last forever. And so you have to remember when you're looking at your portfolio and you're picking those funds that you can't fall into prey of, hey, US large cap's always going to outperform. So let's just put it all into the S&P 500. That's not going to hold for the rest of your life. So the bottom line is that great returns sometimes breed overconfidence, and smart investors do their best to avoid those overconfident moves. If you follow these 5 steps, I really think you're going to put yourself and your family in a better position to have a more diversified portfolio, de-risk your portfolio going into retirement, and you're really going to set yourself up for the different things that we might experience in the stock market. I hope this helps. If you want to talk to me about a free consultation, go to forthrightfinances.com. I'd be happy to chat with you. All right, bye.